आप चेक कर ले मैम एक बार
हाँ हाँ
पीपीटी।
हाँ, कर रहे हैं। Hello, Yanchika. Can
Yes,
you
ma'am.
see
Yes,
supply
ma'am.
chain finance? So
Yes,
today
ma'am.
we'll do the financial aspects of supply chain management. And tomorrow on 29th, you have to give a presentation.
Okay, ma'am.
Okay, the
Yes.
topic will be uh, types and uses of material handling equipment. I've already
Types.
done that. Types
Yes,
and
ma'am.
uses. There are several types and they are used for various works. I've done that,
Yes,
but
ma'am.
you prepare your own presentation, and on 29th you present that, on which we'll ask you certain questions, then you will get your certificate.
Types and uses of
Yes, of
material.
material handling equipments.
Okay, ma'am. MHG.
Huh. MHE.
Yes, ma'am.
Okay, so we'll be doing supply chain finance today.
Okay, ma'am.
Read it.
Yes, ma'am. So it's our last class, ma'am.
This is our last class.
Okay, ma'am. Knowledge of finance is crucial for managers across the board, and finance is much more than accounting, and number crunching. As a manager or project lead, one should be able to understand what is happening by taking an overall cursory glance over the financial reports, forecast, and economic trends. The following are the topics specific to supply chain finance: reverse factoring, trade credit, management of account, reversible, payable,
Receivable.
res-
Receivable.
receivable, okay,
Huh.
receivable, payable, foreign currency, risk management, blockchain technology implementation.
Hmm.
Blockchain, sorry, ma'am.
Blockchain. So, which is the latest technology? Which is it was started for cryptocurrency, virtual money, but now it is being used everywhere
Yes,
because
ma'am.
this is very safe. Okay,
Yes, ma'am.
so we'll be doing what are financial reports, what how do you do financial forecasting, what will be the economic trends, because these things help you in, it is not only just accounting, it is much more than that. Because finance is the backbone of any organization, so we have to see to that the financial health of the organization is robust, it is going into the right direction, it has got enough money to use as profit, enough money to do further investment, enough money that the daily flow is maintained. So for everything, finance is the main thing which is required. So, and reverse factoring, trade credit, these are very, it is not that whether you are in supply chain management or anywhere else, finance is important. But especially for supply chain management, reverse factoring, trade credit, management of accounts, receivable and payable, foreign currency risk management, blockchain technology, all these have a special meaning. Yes. What happened?
Financial, yes, ma'am.
Ah,
Financial reports. Financial reporting is a systematic process of recording and representing a company's financial data. The reports reflect a firm's financial health and performance in a given period. Management, investors, stakeholders, financiers, government, and regulatory agency rely on financial reports for decision making.
yes.
The
Ah,
reports determine business assets, liabilities, cash flow, profitability, and shareholders' equity. Financial reports are standardized by two prominent frameworks: the General Accepted Accounting Principles GAAP and the International Financial Report Standards IFRS.
ah. So financial report is needed by everyone, whether you want to do further investment, if you are the take shareholders, because shareholders are also looking for what? They want their share in the equity, in the profit. So they should know, okay, what is the financial, because it tells you the financial health of the company. So they also want to do the companies which are financing your organization, they also want to know how, what is your financial whether whatever has been given to you has been utilized properly, it is giving the proper desired result or not. Then the government is also interested, because they want to know how your company, it is not going sick, or it is a robust company. Any regulatory agency, they are also so financial report is needed by everyone to judge the company. And some standardized frameworks are used. One is the general accepted accounting principles, and another is your international financial reporting standards. These are things which are generally I'm not from finance, so I can't tell you the detail of this, but these two are the main framework which is used for generating these reports.
Financial forecast. A financial forecast is an estimate for future financial outcomes for a company or a project, usually applied in budgeting, capital budgeting, and our evaluation. Depending on context, the term may also refers to listed company quarterly earning guidance for a country or a economic. Typically using historical internal accounting and sales data in addition to external industry data and economic indicators or financial forecast will be the analyzed modeled prediction of company outcomes in financial term over a given time period for the component steps of businesses modeling here sees outline of finance and financial modeling.
So financial forecast is, you want to know how much the money the company requires, how much money it has, for where it can allocate that money, what will be the project. So for this they need their historical data, plus the sales data, plus in addition what is happening in the external environment. All this together they analyze and try to find out financially what they'll have to do in the future, and for that you need financial forecasts.
What is this, ma'am? Agreeably.
Arguably, this is the argument, the key
Okay.
aspect.
Okay. Arguably, the key aspect of preparing a financial forecast in predicting revenue, future cost, fixed and variable, as well as capital, can then be estimated as the functions of sales via common sized analysis, where relationships are derived
Right.
from historical financial ratio and other accounting relationship. At the same time, the resultant line item must talk to the business operations. In general, growth in revenue will require corresponding increase in working capital, fixed assets, sees her owner earning, and associated financing. And in the long term, profitability and other financial ratio should tend to the industry average. See valuation using discounted cash flow and determine cash flow for each forecast period. For more detailed discussion and other consideration, also cash flow forecasting.
So here you need this financial forecasting for predicting what will be your revenue in future, the way you're working today, what is according to the what will be your fixed cost, what will be your variable cost. On that you can you can make a forecast ki what will be your revenue, where will you invest it. So all these things come into the financial forecast, and it is very essential for the company to grow.
Ma'am, the prediction is not accurate. Now it's like
It
fluctuate
is
हो सकता है.
again, there can be, it will never be 100%. No matter how good your analysis, by fluke once in a while it can be, but you should try to make it tending to that actual reality. But how things will actually move in the future, you don't know. Nobody knows. Even the best pundits, I mean, pundits in the sense who are very good in analyzing data and making for financial forecast, they can also can say with, maybe they can say with 99% confidence, or they can say with 90% confidence, but 100% confidence till date, it is not possible.
Yes, ma'am.
Can you hear me?
Yes, ma'am, I can.
Okay. Then you have to see the economic trend also.
Okay, ma'am. Economic trend. An economic trend is the long term direction of an economic. The trend can go up, down, or sideways. An upward trend means the economic is growing and wages are rising. A downward trend means the economic is shrinking and unemployment is increasing. A sideways trends mean the economic is neither growing nor shrinking. There are several economic trends that managers should be aware of when making decisions. Some of these trends include the business cycle. This involves fluctuation in economic activity that business experience over time. By taking business cycle into consideration, managers can make better decision about things like inventory, hiring, and investment. Inflations. This is the general increase in the price of goods and services over time. Inflation can eat into profits, so manager needs to understand how it will impact their business.
So, see, economic trend, naturally, if the whole country economy is not doing well, so it is going to affect even your business, the business which you are owning in that supply chain, whether you are a manufacturer, whether you are the supplier of raw material, or whether you are owner of the warehouse, whether you are a retailer, even the consumer, his or her buying capacity will also increase or decrease according to the economic situation. That is why so many times, to pump up the economy, government pushes some money in the economy so that the wages of the employees increase and they have more buying power. So it is very essential to keep an eye on the economic trend in the economy, whether it is going up, whether it is going down, whether sideways means not going up or down, it is more or less stable. So we have to see the business cycle. Business cycle is what? Anything which, it is not stagnant, it is not static. Sometimes it is going up, then it is going down. Maybe because of some natural disaster, it is going down, or maybe there is a war, it is going down, or overall there is a global recession, then it is going down. So accordingly, you will have to adapt your company so that your whatever risk you are facing is minimized. You cannot do away with it, but at least you can take certain measures when it can be minimized. Like when in 2008, when there was a global recession, then Prime Minister Mr. Manmohan Singh, who is an economist also, he protected our Indian economy in such a way that we were not that much affected by it as other countries. We were protected by his policies. So similarly, because he was the prime minister of the country, and it was his duty to look, and besides that, he was also an economist. So he looked into this matter and protected us. So similarly, every uh, one in the company, or especially the people who are at the decision making level, they have to see these things and accordingly try to adjust its company according to the changing environment. So, inflation, what that is, what the rising prices. Naturally, when if the prices are rising very, so naturally the purchasing power of the people will go down. So you have to see, and it will eat into your profits. So you have to see how this trend can be minimized, what indices should be taken so that it is minimized and it is not growing that. So some, anyone who is at that level, it is not in the hand of everyone, and Even I think the owners of the company, it is the regulatory bodies who have to see the inflation is under control. Then interest rates.
Interest rate. These are the rates charged by its lenders
Lenders.
for borrowing money. High interest rate can make it expensive for business to borrow money for expansions or other investment.
Like
Ex-
suppose
yes,
you
ma'am.
are taking money from the bank. A bank is charging you high interest rate. Then what will happen? Naturally, where will you get that? You have paid high interest rate on that money, so the things will become costlier. So that is why sometimes the government has to intervene and see if the bank is not asking for too high interest rate, so the whole economy of the country will be affected. Then exchange rates.
Exchange rate. These are the rates at which one country currency is exchanged for another currency. Exchange rate can impact a business's bottom line by importing or exporting goods and services.
Mhm.
Economic indicators. These are many economic indicators that managers can watch to get a sense of where the economics is heading. Some example including the domestic product GDP, unemployment, and consumer confidence. By understanding these economic trends, manager of companies can make better decision how about how to operate their business.
So, say exchange rate, like for example, today compared to dollar, the rupee has gone down. We
Yes.
are paying, we'll be paying more. Even for $1 now, we are paying more than 80 rupees, which was some time back it was much less. So if we are importing something, it will become costlier. Naturally, if your input, you are importing the input at a high rate, then naturally the prices which you will charge will, so your operation will be not cost effective. So it is the duty of the government to make such policies that the exchange rate is under control. Just 1 second, 1 second. Hello. Yes. The exchange rates, especially in if you are dealing with other countries, you are in export and import business, then this exchange rates matter a lot. Then economic indicators like GDP, unemployment, and consumer confidence matters a lot. If domestic product GDP goes down, so naturally consumer confidence will also go down. And if employment rises, unemployment rises. That is what is happening today in India. Unemployment has risen so much that the confidence of the consumer has gone down. Then from where to, because main thing is their earning capacity, then only they can have a good life. So even the businesses has to see that these things are working properly, because after all, why the businesses exist? They have certain duty toward the society, so that more and more people get employment, they have a better lifestyle. It is not only the duty of the government, but even the businesses to see that these things are followed. So by understanding this economic trend, managers of companies can make better decision about how to operate their business. You get my point?
Yes, ma'am.
Then you have reverse factoring. This is very close to SCM, supply chain management.
Okay. Reverse factoring is a financing method that improves the cash flow of both buyers and seller by using a bank or a similar finance institutions. The buyer contract with a third party financial institute or a financial partner that steps into the middle of certain buyer seller transactions. The financial partner pay the seller, giving the buyer additional time to pay for its purchase. That means the buyer get to hold on to its cash longer, which improve its working capital. The seller receives payment directly from the financing partner much sooner than its original invoice term would otherwise allow, which improves the seller's cash flow. In return for financing a relative low risk scenario, the financing partner receive a fee from the seller and interest charged from the buyer.
So here a middle financing company comes between the buyer and the seller. So they pay something, a small fees to the financing company, but instead of the buyer paying directly to the seller, it is through the financing company pays the seller, and later on, once they are in a position to pay, it is an agreement. So they can pay back the financing company.
While the term sounds similar, it is important to note that reverse factoring and factoring are two different things. Reverse factoring, also known as supply chain finance or approved payable financing, is a finance arrangement that is infected by the buyer for commercial transactions.
Transaction. So it is very like factoring is used by any company, but reverse factoring is an important part of supply chain management.
Reverse factoring process. The buyer and its supplier will be on board for the reverse factoring process or program. In most circumstances, buyer offer reverse factoring only to its most creditworthy suppliers. Following is the stepwise process of reverse factoring. First, the buyer place an order. Second, supplier fulfill the order and generate invoice for the buyers. Third, the supplier's invoice is improved by the buyer and confirmation is made regarding the payment to the financial institute at the maturity of the invoice. Fourth, the supplier then has to sell the invoice to the financial institute at a predetermined discount rate. Fifth, after this, the supplier received the fund against the invoice immediately.
So first the buyer places an you place an order. Suppose you want to buy raw material. So you place an order to the supplier.
Yes.
Supplier fulfills the order and generates an invoice. At that time, the supplier does not get the money. The supplier invoice is approved by the buyer, and the supplier approves the supplier buyers approves the supplier's invoice, and confirmation is made regarding the pay. The financial institution has to do the payment. The supplier then has to sell the invoice to the financial institution at a predetermined, whatever is the rate, discounted rate. It has to sell it to the financial, and financial institution does the payment. After the supplier receives the funds against the invoice immediately, then the supplier receives the, it is not directly from the buyer to the supplier, it is through a financial institution. For example, today even we, when we buy something, isn't it, it is through our bank.
Yes.
Suppose you are online, you are placing an order, so they'll ask you for the money. Sometimes you pay it in cash, sometimes you pay it directly through your, so you are not paying directly to the person, but you are asking your bank to pay the money to the whoever is selling you the product. So this is a
No,
pictorial diagram of this reverse pack. See here, supplier, logistics service provider,
I know. Yes,
uh,
ma'am.
and
Yes.
this is buyer. Once he receives, he sends, supplier sends goods and invoice to the buyer.
Bye.
Okay.
Yes, ma'am.
Second is buyer approves invoice and informs platform. Platform is this financial institution. This is financier.
Okay.
Supplier directly asks for payment. Fourth, platform informs financier. Platform, this is the portal. From there, it goes to the financier.
Yes.
Financier pays supplier. Financier pays supplier. Buyer does not pay directly to the supplier. Buyer pays on date of invoice. On date of invoice, it will pay to the financier. At that time, it will not. At the date of invoice. So buyer gets some time to do his daily core. He has some money, he has got some time, but the supplier gets the return on his goods. Is it clear?
Yes, ma'am.
The six supplier sends goods and invoice. Second is buyer approves invoice and informs platform. Third is supplier directly asks for payment. Fourth is platform informs financier. Fifth is your financier pays supplier. And sixth is buyer pays on date of invoice. So finally, the financier also gets his money, but it is not, and the seller is also getting it money, but it is through a financier, so that both buyer and seller are satisfied. So, what are the benefits for buyers?
Benefits for buyer. First, the buyer can have access to the longer payment term with the supplier without even negotiate over any factors such as price.
Hmm.
Second, there is an increase in trade payable, which results in the buyer experience efficiency in day-to-day business operation. Third, provide optimized working capital for the buyer. Fourth, the buyer can avail benefits of cash discount even after paying for the invoice at its maturity date.
Hmm.
Fifth, this helps in raising further source of finance at better rate. Sixth, this can act as a major benefit to buyers in terms of accelerated cash flow. Seventh, the company no longer has to deal with the request from supplier regarding early
Early
payment.
payment. So here, because at that time the money does not go, he does not pay this, he will pay maybe the invoices once he gets some money from his consumers. So at that time he will pay, or at something which is convenient to him. So it gives them time for the day to day running of the operations. Plus the negotiation is done through the financier, so he does not have to deal with the trade terms and all those things. Hmm. Benefit for suppliers.
Benefits for supplier. First, the supplier gets faster access to cash that's to an advantageous rate. Second, the result is faster cash conversion cycle from delivery to cash. Third, the overall balance sheet of the supplier becomes efficient for getting future finance at better rates. Fourth, a cash strapped supplier is generally paid much sooner than the normal supplier in exchange for the finance company's fee.
So here the supply is also benefiting from this scheme, because the supplier is getting the money, especially cash strapped. If it's a cash strapped supplier, he gets it at a sooner rate. He has to pay some finance company fee and he gets all the money he wants. So his balance sheet is also efficient, because whatever he has supplied, he has got the return on it. So balance sheet is what you give and what you take,
Okay.
the liability and the assets. So your asset you have sold, and the you have got return on those things. And that is why the cash conversion cycle is shorter. Immediately your delivery is turned to cash.
Yes, ma'am.
Yes, read it.
Yes, ma'am. Who benefits from reverse factoring? Both buyer and supplier can experience smoother experience using reverse factoring, as they have to deal with financial institutions for payments. This helps to further translate in strong cooperation amongst the buyer and suppliers, which create competitive advantage. All three parties get benefited from reverse factoring arrangement. The bank charge certain interest on reverse factoring and avail ongoing income by providing this service.
Mm.
Retailers can develop good working relationship and can retain good and reliable relationship.
Mm.
Suppliers get great working capitals.
So everyone, even the bank is not doing it for free. It is also charging something. But this way, things become more smoother for all these three parties.
Documents for analyze and decision making. supplier list, previous annual financial statement, last two, articles of incorporation and association, documentation which disputes full tax complaints.
Tax compliance. So they have to see from the suppliers list whether the supplier is trustworthy or not, what is his previous financial statements last 2 years, articles of how when it was incorporated, what is his association, because they make sure that the supplier is credit worthy. Otherwise they will not come into this agreement of paying the supplier, because the supplier, if he vanishes, then all the money is lost. So the credit worthiness of supplier is judged by the financial institution, and then only this reverse factoring will work, and whether they have paid their full taxes or not. So all this, the tax returns, everything is analyzed before this agreement is taken up. Is it clear? Reverse factoring. Now
Yes,
we'll
ma'am.
go to trade trade credit. Sorry.
Okay. Trade credit. Trade credit is a business to business B2B agreement in which a customer can purchase goods without paying cash upfront and paying the supplier at a later scheduled date. Usually, businesses that operate with trade credits will give buyer 30, 60, or 90 days to pay, with the transaction record through an invoice. Trade credit can be through though of as a
Cost.
type of 0% financing, increasing a company assets while deferring payment for a specified value of good or service to some time in the future, and require no interest to be paid in relations to the repayment period.
Mhm.
Key takeaway are: trade credit is a type of commercial financing in which a customer is allowed to purchase goods or service and pay the supplier at a later scheduled date. Trade credit can be good way for businesses to grow up cash flow and finance short-term growth.
Mm.
Trade credit can create complexity for financial accounting depending on the accounting method used. Trade credit financing is usually encouraged globally by regulators and can create opportunities for new financial technology, fintech solution. Suppliers are usually at a disadvantage with the credit as they have sold goods but not received payment.
So here, there's no financial institution, but the buyer does not pay it immediately. There's a agreement. They give them 30 days or 60 days or 90 days as the agreement is, and later on they can pay it. So it is to the supplier, he is not getting it immediately, but the buyer is getting a time, and his cash flow is not hampered. Here is a trade credit. How trade credit works. This is the business. So here goods are supplied at no cost. Business sells products. Once he has got return from the customer, he pays. Sells the product to the customer. Customer pays for product. Business pays invoice, and now it goes to supplier. So it is a circle, but it has given the business time to get money from the customer. Over there was a financial institution in between, which was paying the supplier without getting return from the customer. But here it is without a intermediary, but there is a agreement between the supplier in the and the buyer, that they can pay it once they get the money from the customer. That is what is trade credit. Is it clear?
Yes, ma'am. Understanding trade credit. Trade credit is an advantage for a buyer. In some cases, certain buyers may be able to negotiate longer trade credit repayment terms, which provide an even greater advantage. Often, sellers will have specific criteria for qualifying for trade credit. A B2B trade credit can help a business to obtain manufacture and sell goods before even having to pay for them. This allows businesses to receive a revenue stream that can retroactively cover the cost of goods sold. Walmart is one of the biggest utilizers of trade credit, seeking to pay retroactively for inventory sold in their stores. International business deals also involve trade credit terms. In general, if trade credit is offered to a buyer, it's typically always provide an advantage for a company's cash flow.
So actually, Walmart is a big company. They know that they are selling so much. So the seller will not be at cost loss. Late Sooner or later they'll receive the uh, amount they need for their goods. So you have to be again over here. You have to be credit worthy. Then only the supplier will agree to give you a trade credit. Hmm.
The number of days for which a credit is given is determined by the company allowing the credit and is agreed upon by both the company allowing the credit and the company receiving it. Trade credit can also be an essential way for business to finance short term growth because trade credit is the form of credit with no interest. It can often be used to encourage sales.
So because here you are not, it is, as it was said, it is 0% financing. They are not taking any interest on that, and they are also giving you some time to return the money. So this way they can use this time to grow their business. So later on they can buy more from the seller. So the seller has a better opportunity with them. So this is a way to encourage sale.
Since trade credit puts suppliers at somewhat of disadvantage, many suppliers use discounts when trade credit are involved to encourage early payment. A supplier may give a discount if a customer pay within a certain numbers of days before the due date. For example, a 2% discount if payment is received within 10 days of issuing a 30-day credit. This discount would be referred to as 2% by 10 net 30 or simply just 2 by 10 net 30.
So see, over here, they have made an agreement that after 30 days they'll be receiving the payment. But if they receive it after 10 days, they are giving them discount. So this way the supplier is also receiving it earlier, and the buyer is also getting a discount of 2%. If you had bought it for 10 rupees, say, so instead of that, now has to pay only 8 rupees. So 2% discount. 10 days, within 10 days he is paying instead of 30 days. So it is 2% or 2 by 10 net 30.
30.
In short day, it is the meaning of the whole thing is that a supplier may give a discount if a customer pays in within a certain number of days before the due date. Okay.
Yes, ma'am. Advantages and disadvantages of trade credit. Buyers. The advantage of trade credit for buyers includes simple and easy access to financing. It is also an affordable type of financing that's come at no extra cost when compared to other means of financing, such as a loan from a bank. Because payment is not due till later, trade credit improves the cash flow of businesses. They can sell the goods they acquired without having to pay for those goods till a later date. Trade credit also improve your business profile as well as your relationship with your vendors. The disadvantage of trade credit include high cost if payment are not made on time. Cost usually appear in the form of late payment penalty charge or interest charges on the outstanding debit. If payments are not made, this can also negatively impact the credit profile for your business as well as the relationship with your supplier.
So buyers are getting advantage. They are getting something, and they have to do not have to pay. But then whatever you have said, you have to pay by. Otherwise, you will have to pay penalty. So this is a risk. If you have given them a 30-day credit, then after 30, you should make it sure that after 30 days, the amount for the goods has come to you and you have paid. Otherwise, your relationship with your supplier will deteriorate. You will not get, because this is not a one time relationship. It is how credit worthy you are, how good you are at keeping your agreement intact, how. So this is going to affect your relationship with your supplier. So you have to be very careful to sell your goods within that period so that you are able to pay back the supplier.
Now, sellers. The advantage of trade credit for sellers include building a strong relationship with your client, encourage customer loyalty, and therefore repeats business. Trade credit can also lead to higher sales value as buyers are likely to purchase more when there is no cost associated with the financing.
Mm.
Sellers have a few more disadvantages than buyer when it comes to trade credit. These include delayed revenue. If a business is flush with cash, that's not a problem. If budgets are tight, then delayed revenue might be an issue in terms of covering operating cost.
Mm.
Trade credit also come with bad debit, as some buyers will inevitable not be able to pay. This mean a business take on risk when extending financing. Bad debits can be written off, but having a customer not pay can always be detrimental to a business.
Detrimental.
Detrimental to a business.
Detrimental to a business. See, over here, there is a risk also to the supplier. Suppose they do not get the money, or if they are short of cash, so they need their money immediately, then they cannot give credit. It is only if they have that financial leverage, then only they can give. But at the same time, if they have the financial leverage, their business will grow because people will buy more from them, because the business will also think it immediately. They don't have to pay, they will sell the goods and then they'll sell. So overall, both sellers and buyers will have a very good relationship only if buyers and sellers, they are committed to the commitments which they have made to each other. Okay.
Yes, ma'am.
Hmm.
Pros and cons. Pros: cost effective means of finance for buyers,
Hmm.
improve cash flow for buyers, encourage higher sales volumes for sellers, leading to strong relationship and customer loyalty for sellers.
Hmm.
Cons: high cost for buyers if payment are not made on time. Late payment or bad debits can negatively impact a buyer credits profile and relationship with suppliers. Seller run the risk of buyers not paying their debits. Delayed payment can be strain on the balance sheet for sellers.
uh, these things we have already done. Cost effective means of financing for buyers. They are getting a, they are being financed at 0% interest, so their cash flow improves. They can buy more, encourages higher sales volume for sellers. Sellers are able to sell more, leads to strong relationship. And if it is working properly, there will be a strong relationship between buyers and sellers. But at the same time, high cost for buyers if payments are not made on time, because then they'll have to pay penalty, and that will increase the cost of the product. And naturally, his they are not able to pay on time, then his credit worthiness will be affected. Later on, nobody will be ready to give them goods on credit. Seller run the risk not paying the, but if the sellers don't, naturally they'll be at a financial loss. Delayed payment can be a strain on the balance sheet of for sellers, because if they are not getting it, their business will be affected. So it is a relationship, very good relationship between buyers and sellers, but at the same time, both have to see to it that whatever has been committed is being really taken care of. Then you have management of accounts receivable and payable.
Understanding account payable and receivable management is crucial to maintaining a healthy cash flow and for better financial practice. Accounts payable is the amount owned by to any business. The management involves sending, managing, and tracking the payments.
Mm.
Account receivable management takes care of tracking the amount of businesses has to take after providing it products and service. It is essential to properly manage both AP and AR for the better stability in the one's finance. And online accounting software like Invoice it is, ma'am.
Invoicera.
Invoicer can help streamline the process.
See, anything you're selling something and you're buying something, like you're selling something that is, and you're for that you are getting some money, so you are receiving also, you are paying, and you have to keep track of both the things. It is easier for a household to keep track, we can take it manually, but for a business it is a, so many transactions are going on, so keeping track of them manually, sometimes it was not that the people were not keeping track of it manually, but as the complexity of the business is increasing, doing it manually takes a lot of time, and there can be some error also. So now software has come which will keep track of both your payable and receivable. When you have received the amount, at what time it is due, it can give reminders to the sellers to when to pay the or to the buyers, as the case is. So that even now so many times we get uh, notices from banks. Suppose you have taken some scheme where you have to deposit some money at a monthly basis or yearly basis or 6 monthly basis, so before the actual time comes, you get notice from the bank, this is your due date, so keep sufficient amount in your account. So this way the bank's job, because they are what, that is their receivable, and for me it is payable, so they can keep track of things in a much healthy way. Yes, this is Invoicera.
Uh,
Invoicing simplifies it, it simplifies. So you have two things: accounts payable, which is the money you owe to vendors, you have
Yes.
to pay to the vendors, you have bought some goods from them, you have to pay to the vendors. Accounts receivable is the money owed to your business, now you'll sell it to the customers and you'll receive some money for the goods, so that is your receivable. So keeping track of these things, this Invoicera, which is a software, does this job in a more efficient and effective way.
What is accounts payable management? To make it simple, these are the unpaid bill a company has yet to pay. It's required to keep track of all the bills and invoice a company has received. Here comes to account payable management. The management generally include controlling all the aspects of account payable. Paying one bill on the time is important. If one doesn't think can go the wrong way, one might miss payment, break trust with supplier, and even face legal obligations. That's why tracking one's bill is key.
Mm.
By having invoicing software for handling bills, one company can save money on payments, work out better deals with supplier, one pays on time, and keep everyone happy. Invoicera can help with these by automating payments, keeping track of one's spending, and even letting one pay bills online. This make managing bills easier for any business size.
Mm. So you have to keeping track of it, keeping paying in on time, because this also gives you a good relationship with to whomever you are paying. So so this software helps you in achieving managing the whole accounts payable.
What is accounts receivable management? What is receivable management? Account is receivable management is defined as the practice of managing customer payments that are owed to a business in entails monitoring unpaid invoices, following up the clients for payment, and account reconciliation. It can be hassle to keep track of account receivable, but an account receivable software like Invoicer can help business can get paid faster and avoid debate by setting setting clear rules on how and when customers can pay, sending accurate invoice quickly, following up on late payments, keeping good records of everything, make sure any missed payment are chased up. The above steps can help businesses to have a healthy cash flow.
So I think this is quite easy to
Yes,
understand.
yes, ma'am.
It can keep tag of everything, setting clear rules on how and when the customers will pay, should pay, then sending them accurate invoices, not high or low, following up a late payment, following up the, if there is payment is a following up, seeing that it is paying, and if it is paying late, then some late fees can be attached to it. For example, these days when you are doing some course online, like for example in IGNU, they have set certain date to pay your examination fees, but suppose you are not able to pay it, then you can pay it later. That is also a date is set, but you have to pay some late fees,
Yes,
isn't it?
yes,
So
ma'am.
similarly, any business can keep track of things. They are also using some software which is sending messages to the students so that they are doing the payment on time, and they are also sending them messages when to pay and everything, all the information, keeping good records of everything, making sure any missed payments are chased up. If suppose you have missed something, you will be able to easily chase it. So this helps you managing your receivables.
Tips for managing account payable and account receivable. Establish credit policies. One thing owner and managers don't like about transaction is when they take a long time to close. Receivable department often establish credit term which may vary according to the clientele they serve. Regular customers with good credit rating receive a greater flexibility period for payment, whereas first time customer may not given as much leeway. When it comes to payment term, most companies establish term at 15 to 30 days. Accordingly, payables department should pay surprise as soon as the shipped item arrives in good condition. If you do so, you might even be able to take advantage of discounts offered by supplier for early payments.
So you should be very clear about your credit policies. Suppose they are able, they are paying it before the due date, they can get certain discount, and uh, uh, so it is very the people department has to keep a very strict eye on the whole transactions. Second,
Yes, ma'am.
hmm,
Shorten transaction cycle. A shortened transaction cycle for items bought and sold will save your company money on a labor dedicated to make those exchange. Longer cycle might be symptomatic of workflow but neck or low cash flow as occurs when a company opts to wait to be paid for a sales before repaying a supplier. To avoid this situation, establish timeline for receivable and payable. Better still, establish shorter receivable timeline so that you can quickly deal with your account payable. Get department into the habit of issuing invoice, purchase order and other documentation on designated days of the week or month to create a routine you can work with.
see, your transaction cycle should be short, so that don't take it so long that you get the receivable after a longer period, so naturally you'll do the payable, so this will hamper even your work as well as the supplier's work. to give, and the relationship will also be so it is best to keep it short, so it is beneficial both for the supplier as well as for the buyer.
That's fine. Foster more communication. Think of accounts receivable as your left hand and accounts payable as your right hand. Now, juggling bit two, isn't it? Companies might struggle to stay on top of both departments, especially when dealing with large volume of transactions. To make this easier, each department should consult the other on purchases and sales affecting the company. If there's huge consumer demand, receivable can signal payable to order more item. It
It
times are
times are.
tight. Payables may want to curbs procurement until there greater stability.
See, because see, any it has both the hand. You can take it as one as a left hand and another. So you are getting money from somewhere you are paying. If you are getting more demand, so there should be a communication, very faster communication between payable and receivable. If the customer want more, so they are ready to pay more. So you can pass this information to the your seller. They can provide you with more input. So there has to be very good communication and faster communication between these two, because they are working together. What you are receiving, you are paying. Yes.
Stay on the top of aging accounts. One should be recording all the transaction immediately and issuing statement regularly, but it is also prudent to look at old accounts to make sure that everything settled up. If any outstanding receivable are on the books, that take action immediately and suspend any further businesses with that particular client until their account is balanced. Set up a policy indicating that maximum period it should take to clear a customer account. Similarly, for payable, if suppliers are missing payment within a designated time period, pony up as soon as possible and establish a timeline for when payables should be cleared.
So both transaction, payable and receivable, you have to keep transaction record of the transaction. But in case some old payment is due, then clear it as fast as possible. If from the receivable side as well as the payable side, to keep account of all the things, whether new or old, you have to keep account of everything and see that the business is moving properly.
Use automation to track everything. Tracking accounts receivable and payable involves the creations of invoice, receipts, shipping orders, purchase order, financial statement, and other documentation. It is a painstaking process and one that's even more cumbersome if even a single document slips under the radar. Using accounts payable software to automate all these transactions in real time allows for the quick complications of information needed for financial statements and can help track anomo- anomalies such as
Delinquent accounts are interruption in.
interruptions in workflow.
So if you automate these things, there are so many things going on. You are tracking accounts. This involves creation of invoice, receipts, shipping orders, purchase orders, financial statements, another. There's so many. So doing it manually, maybe you will make some slip. So if you are automating it, things become more effective and efficient. Now next is your foreign currency risk management.
Foreign currency risk management involves strategy to mitigate the impact of exchange rate fluctuations. Some common strategies are hedging techniques using currency forward futures, options, and swap. Natural hedging, matching revenues and expense in same currency. diversification, spreading investment across different currencies, netting and offset arrangements, combining transactions to reduce exposure.
So see what happens, like especially in your, if it involves some other country. So today, suppose uh, the price of rupee deteriorates further compared to what will become the things you are importing will become costlier. To so you need certain, see, it is unavoidable, something will happen in future, it might go up, it can be, it is always happening. So there are certain techniques, actually I won't be able to explain to you very clearly because I'm not from finance. So but there are techniques which you can use to mitigate that, so minimize it. That is what we can do. Like for example, it is not that you can do away with diseases, but then you have doctors who will give, can prescribe you medicines so that your disease is mitigated, minimized. You can tolerate it, you can live with that particular disease. For example, suppose you have sugar, you take insulin or any other tablet every day and your sugar is under control. So it similarly over here also, you take a certain risk, like for you, hedging techniques, it is something like an insurance. Like what you do is, you, when you buy something, you insure it for, suppose you you pay some small amount, suppose your vehicle meets with an accident, you get a benefit from it. Sometimes if it does not get, you lose all that money. It is not that every time it is beneficial to you, but you have to take that because the utility of that decision is very important. If something goes wrong in the future, you will have nothing to rely upon.
Hedging techniques. The best way to understand hedging is to think of it as the form of insurance. When people decide to hedge, they are insuring themselves against a negative event's impact on their finance. This doesn't prevent all negative events from happening. However, if a negative event does happen and once is properly hedged, the impact of the event is reduced. Hedging techniques generally involve the use of financial instruments known as derivatives. Two of the most common derivatives are options and futures. When derivatives can develop trading strategies where a loss in one investment is offset by a gain in a derivative. Derivative are financial contracts set between two or more parties that derive their value from an underlying assets, group of assets, and benchmark. A derivative can trade on an exchange or over the counter. Price for derivatives derive from fluctuations in the underlying assets. Derivatives are usually leveraged in instrument which increase their potential risk and reward. Common derivatives include future contracts, forwards, options, and swap.
Like you can say ki, suppose if you have given them some money, so that in case the price rises in the future, it is some period, you won't be affected. So that way you are saving your, building a safe haven for your uh, policy, your business to grow. Or you can, if it goes down, vice versa, both the ways it can work.
Blockchain technology. A blockchain is a distributed ledger with growing list of records blocks that are securely linked together via cryptographic hash. Each block contain a cryptographic hash of the previous block, a timestamp, and a transition data, generally represented as a Merkle tree where data nodes are represented by leaves. Since each block contains information about the previous block, they effectively form a chain compare linked list data structure, which with each additional block linking to the ones before it. Consequently, blockchain transactions are irreversible in that once they are recorded, the data is any given block cannot be altered retroactively without altering all subsequent blocks. Blockchain are typically managed by a peer-to-peer P2P computer network for use a public distributed ledger where nodes are collectively added to a consequence algorithm protocol to add and validate new transition blocks. Although blockchain records are not unalterable, since blockchain forks are possible, blockchain may be considered secure by design and exemplary
Exemplified.
a distributed computing system.
This is, see, the data are linked to one another, and if you want to make a change, then you have to uh, ask each one in that blockchain to make that change. So it is very difficult to make any changes. So it is a very secure way of doing any transaction.
A blockchain was created by a person or a group of a people using the name of
Or
you
pseudonym.
what's
Pseudonym.
okay.
Hmm. It was not his real name. He had kept this name, this
o-
group. Satoshi Nakamoto Mato. He was a Japanese.
okay. Satoshi Nakamoto in 2008 to serve as the public distributed ledger for Bitcoin cryptocurrency transaction based on previous work by
Stuart
Stuart Hobber,
Stuart
W. Scott
Scott.
Shonit and Dave Bayer. The implementation of the blockchain with Bitcoin made it the first digital currency to solve the double spending problem without the need for trusted authority or central server. The Bitcoin design has inspired other application and blockchain that are readable by the public and are widely used by cryptocurrency. The blockchain may be considered a type of payment rail.
Hmm. So over here, it was first actually developed for cryptocurrency. So will be no one central authority to control. Like for example, when you're using Visa or Mastercard, they are being controlled by a central authority. But here, nobody is there because the chain is designed in such a way that you cannot make any changes in it. You have to, because one is linked to the other, and you have to, if you make change, want to make change, then others will be informed and you will be blocked. It is a ledger.
How blockchain technology works. Typically, blockchain is made of several nodes. User every nodes communicate with another node as well as the system to issue transaction. For example, sending cryptocurrency from one user to another user in a transaction. The history of this transaction is recorded by the blockchain. Similarly, every event has its record on the blockchain.
Hmm.
Each node has a public and a private key. At whatever point a node requests a transaction, the combination of both these keys create a digital signature. The transaction in then sent over the chain for approval. Once all the nodes provide their go ahead, the transaction stand validated. It is then placed a new block which is included into the blockchain. The block now contains the hash key of its own as well as its preceding block. Generated by the unique hashing algorithm, it can basically be considered as the address of the block. Hashing essentially makes a string in a encrypted format. This string is the most basic and essential piece of the blockchain logic.
It is encrypted, plus it is the distributed network is connected to each other. So whatever you are doing, whatever transactions you are, it is being passed. So you cannot do any fraud in this. This is designed to do away with fraud in, especially in financial transaction, which is very essential part of your any supply chain. So they are using this technology to do away with fraud, because financial data is moving over the network and it can be easily hacked or misused.
So, blockchain network follows the sequentially transaction processing method. During any transaction, every block checks the hash of the previous block and authorize the transaction only if the hash matches.
Okay. Hmm.
Any change in the data of the block modifies the hash of the blocks too. So whenever a hacker tries to manipulate data in the block, it hash changes. When it's a superseding blocks tries to match the hash, there is rise a discrepancy.
Discrepancy.
Okay. Subsequently, the transition stands dropped, breaking the whole chain. In this manner, guaranteeing security
Security
and
and dependent.
dependability.
So what happens when it is passing? It matches the hash. If does not match, suppose somebody wants to hack it and changes, make certain changes, it will be again matched in the second turn because it is a chain. So, so immediate action will be taken. So over here, this probability of hacking has been almost zero. So this is a pictorial diagram of blockchain.
First, a
Hmm.
user request for transaction. Second, a block representing the transaction is created. Third is the block is broadcasted to all the nodes of the network.
Hmm.
Then fourth, all the nodes validated the block and transaction. Then
Hmm.
fifth, the block is added to the chain. And chain. The sixth is the transaction gets verified and executed.
Okay. So see, so many people are involved, so many blocks are involved. So it is not in isolation, you cannot work. So this makes it less prone to hacking.
Why is blockchain technology important? Listed beneath are few advantages on account of which enterprises are considering blockchain technology over others. Decentralized network. The fact that there is no focal power to control the chain in one of the numerous reasons that makes blockchain network ideal. Participating nodes individual arrives at a consequence among themselves and transactions are after approval from all individual.
Hmm.
Immutable structures, data, and blocks must be added to the blockchain network in sequence, which means no information can be modified or erased, thereby making it immutable.
Hmm.
Cryptograph and hashing. The idea of hashing is used when encryption's algorithm helps store the hash key for each block. Tampering of information turns out to be high inconceivable since each modifications make another hash which breaks the whole chain, therefore preventing it from any manipulation.
Hmm. So it is decentralized. Nobody has a control over it. Everybody in that blockchain is controlling each other. So, so there is no question of misusing this blockchain. It is immutable structure. If there is certain if certain hacking or some other mischief is created, then the chain will break. And cryptography and hashing is used. The hash has to match, otherwise the chain will break.
Blockchain technology was initially developed for and limited only for cryptocurrencies. However, over the year, it is making prominence felt in various industry divisions like finance, supply chain management, healthcare, and so on. In the coming days, blockchain technology is surely expected to rule over the several other industries with its secure and reliable structure.
Mm. So you can see it is such a important technology which is coming up. And since finance is something which has to be really worked in a very secure environment, because now financial information is flowing all over the network. So it has to be very secure. Otherwise, you want to send your money to someone and it goes to someone else, because so many frauds are happening, financial frauds are happening. So we have to be very careful and design certain mm, such networks which will safeguard our financial transactions. Conclusion.
Conclusions. Reverse funding is a suitable supply chain financing strategy for many situations. It provides benefits to supplier, ordering parties, and financial institutes alike.
Mm.
Trade credit is a form of commercial financing that greatly benefits businesses in their operation. It is an interest free loan for a buyer, allowing them to obtain goods with payment due at later data at no extra charges. This allows for improved cash flow and the avoidance of traditional cost associated with financing. Managing accounts payable and account receivable is critical in determining the financial health of any company. Properly tracking and managing them is important not only for assessing overall performance but for helping managers and owners make smarter decisions that can influence an organization's future.
You have already done all this.
Derivatives play a significant role in supply chain finance (SCF) by providing tools for risk management and improving liquidity. Blockchain technology holds great promises for transforming supply chain finance by making a more transparent, efficient, and secure. However, overcome the challenges will be crucial for its
Wise.
widespread adoptions and success.
At present, it is in a very nascent stage. So, and everybody has to understand it and properly implement it. Then only we'll get the good benefit of blockchain technology. That is all in your financial aspects of supply chain management. If you have any question, you can ask me.
No, ma'am.
Hmm?
No, ma'am.
Okay. Then we can say thank you. Thank you for watching.
Thank you, ma'am. Thank you so
And
much.
be ready for your test on for 29th. Okay.
Yes,
Prepare
ma'am.
your presentation. Then we'll
Oh,
ask you certain questions on it and some questions on operations and SCM in general. Okay.
okay, ma'am. Thank you so much.